Over the weekend, the US and Iran announced a preliminary agreement to end their conflict. Wall Street reacted instantly. The Dow Jones jumped to a record 51,671 points, and the Nasdaq climbed 3%. That optimism bled heavily into the tech sector, pushing SpaceX to a $2.1 trillion valuation during its massive stock market debut. Meanwhile, global oil prices dropped 13%, hitting a three-month low of $83 a barrel. Traders immediately priced in a return to normal supply. But financial markets operate on future assumptions. They trade on the expectation of a perfectly healed world that does not actually exist yet. This chart breaks down the Consumer Price Index, showing inflation stubbornly at 4.2%. A massive 23.5% spike in energy prices does the heavy lifting. Looking closely at physical supply chain costs, fuel oil alone is up nearly 59%. That data translates directly to the pump, where drivers are still paying highly inflated prices, despite the recent drop in global crude futures. Paper markets are aggressively pricing in tomorrow's peace, while Main Street consumers are actively paying for yesterday's war. The physical roadblock begins here, at the Strait of Hormuz. Roughly 20% of the world's oil transits through this narrow geographic pinch point. The waterway is currently heavily mined. Before commercial transit can safely resume, naval teams must spend weeks systematically clearing the channel. Inland, several Iranian oil fields and refineries sustained heavy damage. Rebuilding that infrastructure will take months of mechanical labor before production comes back online. Over the course of the conflict, the world completely drained its oil stockpiles to make up for the missing supply. Those reserves have to be physically refilled before global prices can stabilize. Geopolitical treaties can be drafted and signed in a matter of minutes. Restoring physical infrastructure requires months of grinding mechanical labor. Once the water is cleared, a massive backlog of ships will flood the strait. Crude oil and liquefied natural gas tankers will get immediate priority to move through. That prioritization forces other critical cargo to the back of the line, specifically ships carrying nitrogen-based fertilizers. A delay in fertilizer shipments trickles down to agriculture, meaning global food prices will likely remain high through the next harvest cycle. We are already seeing the domestic impact in this chart of the NY Empire State Manufacturing Index. The headline number plummeted to 5.7, driven largely by a severe contraction in supply availability. A localized maritime traffic jam ripples outward, stalling broader manufacturing and agricultural sectors. The physical economy is still injured. This friction lands squarely on the desk of incoming Federal Reserve Chair Kevin Warsh, ahead of his first policy meeting in June. He has to balance a euphoric, record-breaking stock market against consumer inflation that refuses to drop below 4.2%. This model compares rapidly falling energy futures against core PCE, the metric the Fed uses to track underlying inflation. By stripping out volatile energy costs, we see core PCE is rigid at 3.3%, proving that inflation is sticky. The Federal Reserve cannot cut interest rates based on a political treaty. They need mathematical, realized proof that the supply chain is recovering. Because the data remains sticky, the consensus is that the Fed will freeze the federal funds rate between 3.50 and 3.75% for the rest of 2026. That keeps borrowing costs high for everyday consumers, holding mortgages and credit cards, even with the war officially ending. There is a vast temporal gap between the speed of financial markets and the speed of physical economic recovery. True economic relief will not arrive with the stroke of a pen. It arrives by clearing naval mines, the physical rebuilding of refineries, and the eventual taming of inflation.